The stock market is flashing warning signs again, and some experts believe we may be approaching one of the most dangerous financial periods in years. From rising interest rates and massive debt levels to AI bubbles and geopolitical tensions, the pressure is building beneath the surface of the global economy. And history has shown us one thing over and over again. Markets don't crash when everyone expects them to. They crash when people become too comfortable. Right now, investors are asking a serious question. Are we witnessing another major bubble forming before our eyes? The stock market has continued climbing despite inflation concerns, banking instability, layoffs, and economic uncertainty. Major tech companies are leading the rally, especially those connected to artificial intelligence. But some analysts are warning that this could resemble previous speculative manias, like the dot-com bubble of 2000. Back then, investors poured money into internet companies without caring whether those businesses were actually profitable. Today, some fear the same thing is happening with AI-related stocks. Companies are seeing billions added to their valuations simply because they mention artificial intelligence. And while AI is absolutely transformative, markets can become irrational when hype takes over logic. One major warning sign is valuation. Some stocks are trading at extremely high price-to-earnings ratios compared to historical averages. That means investors are paying enormous premiums based on future expectations rather than present performance. And when expectations become unrealistic, corrections can become brutal. Another major issue is interest rates. For years, markets benefited from extremely cheap money. Central banks around the world injected liquidity into the economy, encouraging borrowing, investing, and risk-taking. But now, that environment has changed dramatically. The Federal Reserve and other central banks raised interest rates aggressively to fight inflation. Higher rates make borrowing more expensive for businesses and consumers. This creates pressure across the entire economy. Housing slows down. Business expansion slows down. Consumer spending weakens. Debt becomes harder to manage. And eventually, stock markets begin reacting to that pressure. Historically, rapid rate hikes have often preceded recessions or financial crises. Many people also underestimate the impact of global debt. Governments, corporations, and consumers are carrying enormous amounts of debt worldwide. In the United States alone, national debt has exploded to historic levels. Corporate debt is also becoming a growing concern. Many companies borrowed heavily during the era of low interest rates, but now they must refinance those debts at much higher costs. That can severely impact profitability. And if enough companies struggle at the same time, markets could experience significant instability. Then there's the psychological side of investing. When markets rise for long periods, people begin believing prices can only go up. That mindset creates dangerous behavior. Retail investors start taking excessive risks. People begin investing emotionally instead of rationally. Social media influencers promote unrealistic expectations. Speculation increases. This is exactly what we saw before multiple historical crashes. In 1929, before the Great Depression. In 2000, before the dot-com crash. In 2008, before the housing collapse. Confidence slowly transformed into overconfidence. And overconfidence is often where danger begins. Another growing concern is geopolitical instability. The world is becoming increasingly unpredictable. Wars, trade tensions, sanctions, cyber attacks, and political uncertainty all create hidden risks for global markets. Supply chains remain fragile in many sectors. Energy prices can spike unexpectedly. International conflicts can disrupt investor confidence overnight. Markets hate uncertainty, and today, uncertainty is everywhere. Even the banking sector has shown cracks recently. Several regional banks face serious problems due to rising interest rates and unrealized losses. While governments intervened to stabilize the situation, many analysts believe vulnerabilities still exist beneath the surface. Financial systems are deeply interconnected. One major failure can trigger fear across the entire system, and fear spreads fast in modern markets. Now let's talk about AI specifically, because this may become one of the defining financial stories of this decade. Artificial intelligence is real. Its potential is enormous. But markets sometimes move faster than reality. During bubbles, investors stop asking, how much is this company actually worth? Instead, they ask, how high can this stock go? That shift is extremely dangerous. Some experts believe AI could eventually justify massive valuations. Others believe the market is getting ahead of itself far too quickly. And if expectations fail to match reality in the short term, investors could panic. That's how bubbles burst. But here's the important part. Not every warning leads to a crash. Markets can remain strong for much longer than people expect. Trying to perfectly time a crash is extremely difficult, even for professionals. That's why smart investors focus less on panic and more on preparation. Diversification matters. Risk management matters. Cash flow matters. Long-term thinking matters. The people who survive financial crises are usually the ones who prepared before fear arrived. So what should ordinary people pay attention to right now? Watch interest rates. Watch inflation. Watch unemployment. Watch consumer spending. Watch corporate earnings. Watch debt levels. And most importantly, watch investor psychology. Because markets are driven not only by numbers, but by human emotion. Fear, greed, euphoria, panic. These emotions have shaped every major financial collapse in history, and they continue shaping markets today. The truth is nobody knows exactly when the next major crash will happen. But history suggests one thing very clearly. Periods of extreme optimism are often followed by periods of painful correction. The question isn't whether markets will crash again someday. The real question is, will you be financially prepared when they do? Because in every crash, some people lose everything, and others quietly position themselves for the next generation of wealth. If you enjoyed this breakdown, make sure to subscribe to Find Encrypt for more financial analysis, economic insights, and the biggest stories shaping money, markets, and the future of wealth.